economy has actually been quite strong, very resilient, considering the news that we've heard this year around all of the tariffs. I think the good news is we think the worst case scenario for the tariffs has been avoided, given all the negotiations and developments that have happened in the recent weeks. But we do expect the U.S. economy to slow somewhat throughout the year based on the tariffs, but still remain in positive territory. So no longer calling for a recession this year. And I think inflation has been fairly resilient as well. And we think that will continue to improve throughout the back half of the year, allowing the Federal Reserve to eventually resume cutting interest rates. We're looking for about 2 rate cuts in the second half of this year.
How concerned are you about the volatility that we've seen in the bond markets? There's a lot of speculation and expectations that we might see the 10-year yield at 5%. Is that your view as well? And what implications would that have on the stock markets?
Yeah, I mean, I think the volatility, not just in the bond market, but what we saw pretty much across the board throughout the month of April on the tariff announcements was concerning to us. And I think for a while there, we were, thinking the probability of a recession was increasing. We have started to see that volatility come down as the tariff news has developed into a lot of negotiations and something that we think will be more manageable for both the U.S. economy and financial markets globally going forward. So we're not calling for the U.S. 10-year rate to go to 5%. We actually think it will move gradually lower later this year and throughout 2026, again, calling for 2 Fed cuts in the second half of the year.
In your report, you continue to be positive on U.S. equities and the tech sector despite relatively high valuations. Why is that?
Yeah, I think it's important to point out that, the earnings growth we've seen for U.S. companies, despite all of the uncertainty in the headlines around tariffs, has remained very strong. In fact, we've seen the earnings growth for the Magnificent Seven, so the largest technology companies, at around 15%, which is, roughly 2 times the overall growth we expect in the broader market. And despite that strong earnings momentum, we've seen a lot of the technology sector actually lagging quite substantially year to date. And so while it might seem that valuations are high, in reality, they look a lot more favorable today than they have in a long time versus the broader market. So we are constructive on the U.S. equity market. We think we will end higher over the next 12 months, assuming that we've already seen, or acknowledging that we've already seen a pretty nice recovery in the recent weeks. And technology is a sector that we think should be bought here on the pullback, given that we think there's a lot of great things happening in the sector, whether it's artificial intelligence, software, a lot of areas that we think have a lot lower risk around the tariff uncertainty.
You have been mostly positive on the dollar. You continue to think that the dollar is going to remain a reserve currency of choice. Its market share currently is around 60% compared to the euro in second place with a share of 20%. So even though you think that the dollar will continue to dominate, do you think that the euro might have the opportunity now to increase its market share?
We do expect the dollar's weakened year to date. Given the growth dynamic and uncertainty. And we think it probably weakens a bit more in the near term, although we don't think it loses its reserve currency status. I think what that means to dollar-based investors is that you should not rely on the dollar to remain strong or strengthen from here. And so we're having a lot of conversations with our clients on how do we add non-dollar exposure, and that's primarily happening through investing in non-US equities. So places like Europe, where you can benefit from a decent growth dynamic, but also potential for those currencies to strengthen versus the dollar. I mean, Europe on a year-to-date basis has done very, very well versus the US in euro terms, but in dollar terms, it's done even better. And I think that will continue to be the case near term. And so we are looking to diversify globally. So not just relying on the US, but making sure the portfolios has exposure across the global equity spectrum. And so we are looking to add places like Europe and even Japan to help our clients rely a bit less on only US dollar going forward.
I'd like your opinion on where you see the dollar heading for the rest of this year, and where do you see the euro dollar by the end of the year?
Yeah, a lot of the weakness has already happened. It happened pretty quickly this year. And so I think the view is that US dollar will weaken a couple percentage points from here through year end. We don't give specific year-end targets, but I think we think the dollar is more likely to weaken than to strengthen from here, and so we want to help our clients prepare for that and make sure that they have other currencies in their portfolios.